Us today. I'm Maeve Alsup. I'm a reporter here at Latitude Media. For anybody joining a Latitude Media event for the first time, I'll make a quick introduction before I introduce our panelists. Latitude is a business to business news, research, and events company covering tech, deals, and markets across the energy transition. We're especially focused on how things get built, from proven technologies to first of a kind innovations. And that, of course, includes the topics that we're going to unpack today around how projects get financed. If you haven't already, I really encourage you to subscribe to our newsletters and check out our podcasts. And for the event today, we've got a high level mix of folks on the call from project finance, investment banking, project development, consulting. And for the next hour or so, we're going to dig into the ways that the transferable tax credit market has matured since trading began in mid 2023. It's actually been almost exactly a year since we hosted our last Frontier Forum on the transferable tax credit market with capital markets platform Crux with CEO Alfred Johnson. At that event, we assessed the first 6 months of trading, and we talked about the market's potential to reshape financing for clean energy projects. And my key takeaway from that event in early 2024 was that the market was growing faster than anybody thought it would. Today, we've just finished up the first full year of trading. The market has matured significantly, and clear patterns and best practices are starting to emerge. At the same time, the federal policy environment has shifted in the last few months, introducing some new challenges for the market and added uncertainty for some projects, developers, and technologies. So we are going to get into all of that in the next hour with a group of experts who can speak to different corners of this market, from tax equity partnerships to marketplace dynamics to policy impacts. And the trends we're going to be discussing are visible in data collected by Crux in their 2024 market analysis. So with me today, Crux CEO Alfred Johnson. Welcome back, Alfred.
Thanks for having me, Maeve.
We've also got Crux's Managing Director of Markets and Transactions, Stephanie Detterding. Welcome, Stephanie.
Thanks for having me.
And finally, we're joined by Timmy Closter, who is a Senior Vice President of Tax Credit Syndications with U.S. Bancorp Impact Finance. Thanks so much for being here, Timmy.
I'm excited to be here. Thank you.
Amazing. Well, thanks all. We're going to start our conversation today by digging into the current state of the market, get a sense of what happened in 2024. Then we'll move on to some of the potential considerations or stumbling blocks ahead, and then finally get our panelists' take on how to succeed in the market. And I know everyone will have some questions. You can send those to us via the Q&A function in Zoom at any time during the hour. We've got a great team on the back end who will sift through those, and I'll make sure to save time at the end to get to as many of those as possible. To kick things off, I want to start with getting a quick characterization of how the market performed last year, and hopefully each of our panelists can give us kind of their top line notes. So Timmy, maybe we can start with you. What surprised you the most about how the market evolved in 2024? And then we can pass to Stephanie and then Alfred.
Yeah, I love this question to tee things up. So a couple things I think stood out for me and U.S. Bank in terms of what we were seeing as the market picked up in 2024. I'd say just one, how quickly investors entered the market and were willing to transact. We've been U.S. Bank is a long time tax equity investor in this space. We've been doing these traditional partnerships pre-IRA since 2008. So we've really been a player in the space for a long time. And so just to see how quickly the market pivoted to transfers from 2023 to 2024 and all the new entrants, I think was quite remarkable. And just to put some numbers behind it, I think we saw 3 times the amount of new investors enter the space through transferability that we would have seen in a typical pre-IRA, traditional tax equity partnership market. So a lot of new entrants flooding the market, I think, was one surprising observation. And then just how quickly folks were willing to commit. I think we had a lot of conversations very early in 2024. And so we got to commitments with our volume, first part of the year. And then we were able to really start to focus on closing out those transactions as we moved into the second part of the year. So I'd say getting to commitments early was another, observation from our end. And then also a pivot from traditional tax equity investors to transferability. They are comfortable with the partnership. It's a little bit of a different economic profile, but I think they really saw also the ease of execution, the simplification of accounting and diligence. And so we also saw a shift from our traditional tax equity investors over to transferability too, which was interesting, but makes a lot of sense for all the reasons, as I mentioned. So maybe one last thing is just the size of commitments that investors were willing to make to even new players. They were coming out at the gate saying, we want to do 200, 300 million of capacity this year. So they weren't just dipping their toe, they were willing to dive into the market, which I think really is reflected in some of the growth numbers that, I think Alfred's going to touch on with the report. So.
Yeah, to me, I echo kind of all of those things as what surprised me. The market scaled so quickly in 2024. And I think this was really the first time in my career that I can recall investors or buyers actually reaching out with interest in transfer credits and wanting to enter the market. I think in the past for traditional tax equity, I was traditionally in a seat of going, educating, reaching out to groups who maybe had never even heard of tax equity. So that was an interesting thing to see play out. Obviously, we saw a lot of new technologies be able to transact in the later half of 24. And so that helped us obviously get to this large scale of transactions done. And I was also thinking, like, what else played into the scale that was achieved in 24. And I think the two other things that I would mention are just how insurance really became an active part of these transactions to help mitigate risk. And I know we can talk about that more on the podcast, but again, in traditional tax equity, I don't think we saw the amount of insurance that has come into these transactions to help mitigate risk, to add or bolster a seller's indemnity. And I think that really helped get transactions done. And then lastly, I would just say speed of closing. In our 3Q 2024 report, we talked about how quickly transfer credit deals are able to move. And I think that also contributes to the volume that we saw last year.
I think those are all such great points, and I agree with all of it. It is a real privilege, Maeve, to be back here with you, and thank you for starting with the reminder of the conversation a year ago. It's funny to think back on that because it seemed like we knew a lot about the market a year ago, but the market was 5 months old in terms of actual transactions. Very few deals had closed in an absolute number sense, and so much has happened over the course of 2024. So I think the single thing that surprises me the most is the pace with which we achieve the maturity that the market currently has. And, just to talk about the data for a second, we produced our first market report right before I had the chance to talk to Stephen about it in this forum last year. And that was really in response to the market saying that these transactions were not nearly as transparent as they should be, and that it would be really helpful if there were some central resource on pricing to be able to have more liquidity and transparency in the market. We put out that report, thousands of people downloaded it. We had a great conversation here. And even that report, which at the time provided so much transparency to the market, we just have so much more data than we did at that time. We're sitting on now something like $25 billion worth of transaction information. We think that covers about 75% of the market. And so our ability to extract real themes on what's happening in intra-year pricing, on how different credit categories are performing, what the impacts of all those things are into the market is really, really exciting. And I'm excited to share all that with you today.
Amazing. Well, I think that tees us up perfectly, Alfred, for you to share kind of some of the foundational takeaways from last year. Give us a lay of the land, what we need to know going into this conversation. And I'll just note, I hope many of you on the call today were able to join us last year for Stephen's conversation with Alfred. But if not, we do have a recording of that over on the Latitude Media website, and we can make sure to flag that for folks who want to take a look at it. Perfect. Alfred, over to you. What do we need to know about the state of the market last year?
Great. So Maeve, I'm going to go pretty quickly through this because I want to make sure that we have time for conversation. I always learn when I'm talking to these two, so I want to spend as little time talking at the top as possible. So I'll breeze through the takeaways quickly. Again, this represents about 75% of the total market, we believe, is in our data set. That's about $25 billion worth of specific transaction information that really comes from three sources: proprietary surveys that we do into the market, transactions that are facilitated on the Crux platform, and publicly announced transactions where we have sufficiency of data to be able to extract insights from it. 6 key findings from the report. 1, the market for tax credits diversified and grew in 2024. The statistics on just how much it grew over that period are really impressive, again, indicating the both transparency, efficiency, liquidity, and growing nature of the market. 2, pricing on tax credit deals remains strong. We saw it improve from 23 to 24, and it improved from the first half to the second half of 2024. 3, smaller credits, which make up more than 50% of the deal sample, saw the greatest improvement in pricing as a result of more competition in the market and more buyers, as Timmy pointed out, that are coming into the market and looking to participate in it. Hybrid transactions enable tax equity market growth. This is the 4th takeaway. Basically, we are seeing a coherence and convergence of the traditional tax equity market with the transfer market. And I'll share some observations about what that looks like in terms of total market size. How much is traditional tax equity? How much is so-called hybrid tax equity, where credits are sold from a tax equity partnership? And how many of the credits that are sold in the market are direct transfer credits? 5, as Stephanie pointed out, tax insurance is a really important piece of the market. It is prominent, particularly in ITC, investment tax credit deals, and we'll share some data on that. And then 6, the forward market, and by that we mean people that are committing to purchase future year tax credits. That activity, the volume of forwards in the market, grew significantly in 2024 versus 2023. So quickly, I will breeze through the findings. Again, the market is growing and diversifying. So for a very long time, the tax equity market was in the range of $16 to $20 billion a year of total tax equity that was provided. It overwhelmingly came from sophisticated actors like Timmy and the team at US Bank that were participating in these deals. And the market was inherently constrained on the tax equity side. Transferability was created in 2022. It allowed for direct transfers, so people to sell the credit directly as a developer or manufacturer that was earning the credit to a standalone corporate buyer for cash. And it allowed for partnerships that were doing tax equity to be sellers of those credits. And that has driven a huge amount of growth. So the market in 2023 was about 22 billion of traditional tax equity. And then we estimate 7 to 9 billion of transfers. The market in 2024 is about 28 billion of tax equity. That includes about 6 billion or 7 billion of credits that are sold out of those tax equity partnerships. And then the market was an additional 30 billion, again, including that 7 billion that was sold out of the tax equity partnerships. I will show what that looks like graphically. And another 30 billion of total credits that were sold into the market. So there was a really strong growth that was observed in the market. A lot of that growth is coming from transferability that is enabling access to capital for a much wider set of projects. Over the course of 2024, we saw pretty considerable increasing deal activity. So deal activity in the first quarter was the lowest at about 3.5 billion of closed deals. It grew up to 8 billion of closed deals in the fourth quarter of last year. So the market became more dynamic and more active, with more deals closing closer to the end of the year. So next big takeaway, newer technologies accounted for the overwhelming majority of credit transactions in the second half of the year. In the first half of the year, solar, wind, and solar and storage made up 78% of the market. In the second half of the year, that really reversed with newly eligible technologies, and that would include 45X advanced manufacturing credits, credits associated with critical minerals, nuclear, biofuels, geothermal, standalone storage. Those newly eligible categories made up about 72% of the market. So just an enormous amount of growth was observed in those newly eligible technologies. Breaking that out by specific credit category, by far the biggest driver of growth in the newly eligible technology categories was advanced manufacturing tax credits, 45X tax credits that are associated with the manufacturing of domestic components, principally of batteries, but also of solar and wind components, and also the mining and refining of 50 different types of critical minerals. That category of credits, which is under tax section 45X, made up more than 50% of the market in the second half of the year and is the fastest growing category. Nuclear also was a really meaningful part of the market in the second half of the year that was not a meaningful portion of the market in the first half of the year. And we see those trends continuing. We have a number of very large nuclear credits that are for 2024 and 2025 available in Crux right now. Second key finding, pricing on tax credit transactions remained strong. Production tax credits tend to trade at a premium to investment tax credits. They don't have the so-called risk of recapture associated to them and are a more straightforward transaction. Stephanie pointed to the speed with which deals are happening. Production tax credits transact much more quickly than investment tax credits, with the majority on Crux transacting in less than 6 weeks. The pricing is reasonably flat across the size curve. So we generally see an effect where the largest credits in the market trade for the highest prices. In part, that comes from the quality of the sellers, the indemnity that they're able to provide, and the appetite for buyers. But production tax credits see a pretty minor difference from about 92 on average for sub $20 million PTCs up to about 95 on average for the $150 million plus production tax credits. Investment tax credits don't trade quite that high, but the market is quite healthy. So for $20 million and below investment tax credits, we see pricing at about 90 cents. That goes up to about 93.5 cents in the largest deal sizes. And I should point out that is improved across the board from what we saw in 2023. In 2023, we saw average pricing on production tax credits at about 94 cents. We now see it at 95 across all sizes. In 2023, we saw average pricing on ITCs at about 92 cents, and that is now 92.5 cents across the board. And again, to clarify, everything that I'm quoting here, Maeve, is on the basis of a gross price that is paid by the buyer. There are costs that are incurred by the seller typically, so the net price would be less to the seller than the gross price is. 45X, I talked about a moment ago how the market increased a lot in terms of the volume of 45X that was sold in the market. Pricing also improved from 2023 to 2024, particularly for the smallest sized 45X. We saw that those could trade in the low to mid 80s in 2023. It improved to 93 to 95, sometimes even 96 cents in the highest increments of sale for 45X in 2024, indicating that the market is growing there and it's a segment that buyers have a particular preference for. We can get into more of that as the conversation goes on. We did pick up in the data I observed in my first statement, Maeve, how it's interesting that with more volume of data, we can observe more interesting things about the market. We were able to pick up seasonality in the market for the first time in the 2024 data and saw that there was about a 2.5 cent improvement on average in credit pricing from March to November of 2024. Now, that is not determinative, right? That just shows that that happened in 2024. There are all sorts of factors that could impact seasonality and intra-year pricing, and I'm sure we'll get into that as well. Third finding of 6, competition led to convergence in tax credit pricing. I'm here showing that average bids per credit on Crux, regardless of deal size, were between 2.5 to 3 bids per credit. That is significantly better than we observed in 2023. And with more bids per credit, more coverage of demand to supply, that is better for the liquidity in the market and allows the price to be identified and found more easily by the seller. With competition, sometimes you will see the price go up on the credits. And also with competition, as a buyer, you're able to be confident that you're landing at a market price. We build all of our market data, what we're showing here, into our platform. So buyers and sellers are able to see what we estimate via our models the market price on a specific credit will be. And that enhances, again, the liquidity in a transparent market. Smaller credits benefited the most from increased liquidity in the market. For the sub $20 million credit category, we saw an improvement from 86 cents on average to 89.9 cents on average for ITCs below $20 million. And that, again, demonstrates that there were more buyers in the market looking for more inventory in the second half of the year, and that played out in price. We saw it in all of the different size categories and all of the credit types. We especially saw it in the smallest credits. Key finding 4, I promise I'm almost done. Hybrid transactions enabled the tax equity market to grow. So I mentioned the data earlier where we're attempting to break out the market from traditional tax equity, so tax equity that is invested into a project where all of the tax attributes are retained by the tax equity investor. That is distinct from hybrid tax equity, where some of the credits may be sold into the market. We estimate that traditional tax equity plus hybrid tax equity made up about 28 billion of total investment, but 7 billion of hybrid tax equity related tax credits were sold into the market. And so you see those hybrid tax equity transfers come in as a part of the $30 billion whole of the transfer market. So 7 of it came from hybrid tax equity deals. Another 23 came from direct transfers, other structures like minority investments, and forward commitments. Forward commitments were an increasingly large portion of the market, particularly as the year went on. We saw about $6 billion of forward commitments that closed in 2024, where at least some portion of the deal related to a future year. Tax equity, as I mentioned, has always been difficult for project developers to acquire. Typically, it has been more available for the largest project sizes. And we do see in reporting from our developer customers that many are still reporting that it is broadly unavailable or somewhat unavailable. That's about 72% of the market that characterizes tax equity as that, and only 28 say that it is generally available. So tax equity is a really valuable tool that is still a significant and important part of the capitalization of these projects, but is only available to a subset of the market, which again is why transferability is so important, particularly for these new credit categories that do not have history in the tax equity market as solar, wind do. So for 45X, nuclear, these categories that are emerging as the biggest categories of the market, those are categories that are benefiting disproportionately from the transfer market in a way that other categories have multiple choices, including tax equity. We see significantly more production tax credits that are sold directly in the market versus out of a tax equity structure. For investment tax credits, we see about 57% sold out of a tax equity partnership. So for ITCs, it is a common reality where a tax equity partnership is formed and credits are sold in a hybrid tax equity plus transfer type of transaction. Finding 5, tax credit insurance is broadly available and an important part of the market. Typically, that is covering the structure, recapture, eligibility and qualification, and excessive credit transfer and basis risks. Different levels of insurance are typical in different kinds of transactions. This is sort of the menu, and you'll see developers and buyers have different preferences of what level of coverage is needed. But we see in about 75% of investment tax credit deals, there's some form of insurance. So that is about 56% that is fully insured, and another 20.5% where there's some sort of partial insurance. Only about a quarter of the market is in ITC is fully just coming from parent indemnity and does not have insurance of any kind associated to it. The opposite is true in production tax credits. About 81% of PTC deals do not have insurance. And so there's a really different insurance market and market norms in production versus investment tax credits. Last finding, and then I'm really looking forward to the conversation, the forward market for tax credits really began to develop over the course of 2024. We saw bidding volumes increase on the platform pretty dramatically and consistently over the course of the year, including in the immediate wake of the November election. We actually saw the week of the November election was one of the most significant bidding weeks on the platform. So that activity has maintained. And as that has happened, we saw a lot of buyers come to market in Q4, and inventory in the market was reduced in Q4 for 2024, which led many more buyers to participate in some form of forward transactions. We saw that the number of tax credits, percentage of tax credits that had some component of forward rose from 11% in Q1 up to about 75% in Q4. So really decided effect where the market is looking more and more forward. That was about 20% of total volume in the market in 2024 and indicates that buyers are looking forward and participating in multi-year transactions, which shows both the health and stability of the market, but also some amount of prospective behavior indicating how people feel about the likely future viability and realities of this market. So let me pause there. All of that is laid out in a very long report that is available and will be shared separately. I know a lot of people on this phone call already have it, but I'm really looking forward to the conversation.
Amazing. Thank you so much, Alfred. That's perfect. And we are going to dig into a lot of those topics, emerging technologies, insurance, but we're already getting a couple of questions about policy in the chat. So let's just start, Alfred, with this question I think is probably top of mind for a lot of folks and that you started to touch on. It's only been a couple of months, post-election, but how is federal policy change being reflected in the market? How are you seeing participants handling policy uncertainty and just that shift overall?
Yeah, so federal policy touches so many parts of the market for clean energy broadly. The tax credits that we're talking about here are provided by legislation, and it requires an act of Congress to change those tax credits. That is different from other kinds of federal policy like grants and loans, where the executive branch has more direct authority on their ability to dispense cash that is appropriated or maybe part of a program. The law provides that a developer, manufacturer, miner of critical minerals or rare earths that performs some function, builds the project, produces the thing, is able to access tax credits in some volume, and that corporate buyers or individuals with passive tax liability are able to take advantage of that and purchase those credits. And so because it's current and existing law, you're seeing the market remain quite active. So I mentioned that in the weeks following the November election, bidding activity was the highest we have seen yet. We saw really strong liquidity and demand to supply coverage in the market. We see that continue into the first quarter of this year, where a significant volume of deals are continuing to close and buyers are continuing to very actively come to the market, bid on credits, and progress through deals. So currently, the policy implications of the market are not being directly felt outside of people having a close eye on what may happen legislatively and politically. There's certainly other downstream implications of executive branch policy and potential legislative policy. So for the executive, when Trump came into office, he signed a series of executive orders and actions. One of those executive orders, for example, related to the permitting of offshore wind, and the extent to which the government is providing or not providing permits would play into the future market for tax credits, because if projects aren't permitted, they won't be built and you won't see them in the tax credit market. So that's an example of a way that federal policy out of the executive may have a direct impact. But otherwise, there's a lot of focus on what may happen legislatively. The reality is that the market is watching very thin margins that Republicans have in the House particularly, and thinking about what the implications of various reconciliation strategies by the Republicans could have on the market. That is something people are watching quite closely. But the realities, again, there are that there's pretty long-standing practice where safe harbor is provided to developers who begin construction or invest a certain amount in their projects during a year where the tax credits are available to them. So there is that gives the market some amount of confidence. And there's a general view observation that Congress has rarely, if ever, made adverse changes to the tax code that have a direct negative consequence to the taxpayer. They're typically made prospectively with some amount of phase-in period. But again, people are looking at 90% of projects that are benefiting from the credits being in districts that are represented by Republicans. They're looking at the market that is 72% associated with geothermal, nuclear, advanced manufacturing, critical minerals, biofuels, hydro, all of these categories that are, if not directly supported by the new administration, supported by Republicans in Congress who have been quite vocal about their support for at least some amount of the credits. So I think from a market perspective, what we see is a healthy market continuing, and I anticipate that to remain the case for 2025.
Perfect. Thanks, Alfred. And folks can keep sending in if they've got additional policy questions, send them our way in the Q&A. I see a bunch of questions coming in. Timmy, I want to hand it over to you for the U.S. Bank perspective. And you sort of teed this up in your introduction, but U.S. Bank has been a longtime leader in traditional tax equity, billions of dollars in deals for wind and solar. Can you walk us through a bit about how your strategy has evolved with the emergence of the transferable credit market? And I'm also curious to get your take on the impact of this diversification of the market that Alfred just laid out over the second half of last year.
Yeah, Maeve, great question. So happy to dive in. And Alfred, thanks for all the data. I will just say what Crux has been able to do with the data and sort of compiling that and sort of bringing transparency to the market has been really instrumental, I think, to all this growth as well. So, and it's very validating, I think, as a player in this space to see some of the trends that your data sort of reflects. So kudos to you guys. But for U.S. Bank and sort of our policy and in terms of how we've been approaching growth and in this space, I mean, it's really been business as usual in a lot of respects. We definitely play into that part of the market, which utilizes the hybrid structure that Alfred touched upon, where we're still creating tax equity structures with our sponsors, but creating that optionality to sort of transfer those credits out of that structure to a third-party buyer. And that's really beneficial to both sponsors and buyers for a number of reasons. For sponsors, they want the benefit of an upfront, tax equity commitment. They want the benefit of the step up in basis. They want to monetize the depreciation. And for buyers, they like the idea of working with an intermediary like U.S. Bank, who's underwriting these transactions for our own book. And, so we're able to sort of assist with the underwriting efforts and diligence that goes into buying these tax credits. And there's an alignment there of interest, right? Since we're looking and investing in these projects ourselves. So it's sort of a win-win for the market. And as Alfred touched upon, there's demand for tax equity that's not being met. So by utilizing this structure, what we've been able to see with our growth is it has allowed us just to do more of the same. So we're just able to go to market and do more tax equity commitments with our sponsors, knowing that there is sort of a runway here with new market entrants that we can bring liquidity and capital into the space. And we have time to do that now with transferability. With traditional tax equity, there was a limited amount of time in terms of when you had to bring an investor into the structure for at-risk purposes. Here we have until the extended tax return filing date to transfer the credits out of these structures. So we have more time, and there's more interest and market buyers to be able to sort of bring them along. So all of that has allowed us to grow our platform. And part of that too has been, and maybe this will come through with other areas of the discussion, but with all this growth, you need human resources, right? To be able to ramp up these efforts. You need folks to close the deals. You need lawyers to help, more project finance teams, people to build these projects. So I think that's, as this market grows, I think that's something that we're keeping an eye on, is just sort of how do we, from a human resource perspective, like keep up with this growth. So we're certainly, staffing up and ramping up our resources to be able to keep up with all this volume. I'd say other observations and ways that have fueled this growth, deals continue to get larger, it seems, and that can be due to a number of factors. There are numerous adders now with domestic content, low-income community, energy community that are allowing more capitalization brought to these deals. There's a longer runway for folks with the IRA. And so, bigger projects are getting built, the technology is maturing. And so by having opportunities to invest in larger transactions, it allows for efficiencies for us in terms of being able to do more volume. In terms of technology, to your question, Maeve, a little bit about diversification. We've definitely been playing in those more mature technologies with solar, standalone storage, BESS, some wind, standalone storage, obviously being newly qualified for ITC. We're definitely seeing some, ramping up there. But we're primarily playing in those spaces and continue to focus there. But we are also, watching and getting into the 45X market. So I think all of what Alfred shared there, and I think we'll talk about this more, I would co-sign on that in terms of all the opportunities there. So we're starting to look at new tax credit types ourselves, just to keep, evolving and diversifying.
Perfect. Stephanie, can you add on to that and share a little bit about what we have seen in terms of buyer trends? And we're already getting a couple of questions in the chat to dig into more on seasonality and the types of credits that are garnering more interest.
Yeah, absolutely. So the buyer trends have been interesting, especially if you have the tax equity experience, and just to see how all these new entrants are transacting in the market. And I think a couple of things have played out, and then I expect further evolution in 2025. So, most of the buyers transacting in 2024 were likely first-time buyers. And so with that, I think a lot of them wanted to start with either a PTC, so, lower risk profile. And I think to the data, a lot of those transactions are larger in size. So you can do a large volume of those deals, offset your tax liability with maybe a single transaction. And also, I think with the tax equity or the T-flip structures, a lot of buyers find comfort in purchasing credits that have been due diligenced, or where there's another investor who has some skin in the game, if you will, when they are purchasing an investment tax credit. What's been interesting already in 2025 and to have discussions is now when we're looking at repeat buyers, I think they're trying to figure out maybe where they can either get some efficiencies, whether that's from doing a repeat transaction. So maybe not spending as much internal time on a transaction because they can rinse and repeat. They already have a relationship. Maybe lower cost for a developer because same legal counsel, it's not going to be a full negotiation. But I've also already been having discussions about, we did a PTC, we paid this amount for that credit, would love to learn more about an investment tax credit. And if I can get, a similar risk profile, but more of a discount. And so I think that as buyers become more educated in this market, I expect that we will continue to see a diversification around the types of credits and the underlying technology that they're willing or interested in purchasing. I'll pause there. Alfred, Timmy, I don't know if there's anything else you would add. Otherwise, I was going to hit on seasonality.
Seasonality.
Yeah.
Okay. Yeah. So I think seasonality is very interesting. And one of the things I would note is that at the beginning of 2024, you'll likely recall that a lot of buyers were trying to figure out what was going to happen with the R&D credit. And so they were trying to figure out their tax liability. You have buyers at the beginning of the year sometimes actually finalizing prior year tax credit transactions. And then if it's a calendar year buyer, they're also likely wrapping up their calendar year end for financial reporting purposes. And so I do think that it's typical to see maybe the bidding or the kind of activity for new transactions in the early part of a calendar year lower than maybe what you see play out in the later year. And I feel like we probably have some of that happening right now in Q1 of 2025. But then what's, happens is buyers get a line of sight on their tax liability, and you really see activity pick up in the later half of the year. And that is going to impact pricing, right? Because supply in a given year is relatively fixed based on production and placed in service date for the investment tax credit. And so once you have a fixed supply, as more buyers enter the market later in the year, we really saw competition grow up. And I think in the third quarter of 24, we had bid activity of more than 10 billion in that quarter. So it just, I would encourage buyers, if you are planning on transacting in 25 and you do have a line of sight on your tax liability, right now, you're going to have less competition if you're willing to enter the market.
Stephanie, I love that you made the point about the R&D tax credit dynamics in the first quarter of last year, because I think in a lot of ways, that's a bit of an analog to what we may be observing with policy right now, to the extent that there are buyers that may be waiting to see what happens in the legislative picture. That may be playing out a bit, but might look a lot like the seasonality effect that we observed in 2024. And I think your point is spot on, where there's deals to be had in the market in the first and second quarter where sellers are looking to sell. And for buyers that are able to be prospective about what your liability is going to be in this tax year and come into the market, there's a lot of really great inventory to access in the market right now.
I would echo all of that. And we observed similar trends last year with, sort of a lot of activity and commitments, first half of the year. And then, as we moved into the later half of the year, we really had to shift conversations to forward commitments, Alfred, to some of the data, just because if you don't transact early, you really can miss the opportunity to, secure, large deals or the more attractive volume based on what a buyer's sensitivities and needs are. So I would echo all of that.
Timmy, you guys have such great product that buyers are always knocking down your door. And I know that you didn't have as much inventory in 2024 as appetite that you had in 2024. What do you think the dynamics are going to be like in 2025 on that point? Do you think the calendar will look similar, or do you think it'll look different?
Yeah, good question. I agree with your observation around, we're still moving forward with transactions. I think there might be some sort of wait and see a little bit on capacity. So maybe folks aren't going full throttle with what their potential needs are. They might want to start a little smaller with some of those commitments. But we're definitely having a lot of active conversations right now for 2025. We secured a lot of 2025 commitments in the latter half of 2024, so we're already sort of off to the races with our transactions. But because we are increasing our volume this year based on the demand we're seeing in the market, we're hoping that we're able to service more of the market this year. And so, we're able to sort of bring that liquidity to the space because we're certainly seeing the demand with all the conversations that we're having with investors. Another thing. Oh, sorry. Go ahead, Maeve.
I was just going to say we're getting close on time, so I want to start weaving in some audience questions. We've got a question from Gary Dent who says, "My focus is data center finance. Can energy tax credits help meet the growing energy demands of data centers?" I don't know who wants to jump in on this one first.
I'm happy to start there. So this is such an interesting dynamic in the market. There has been a lot of growth in the consumption of energy from data centers with the rise of cloud computing, the electrification of everything. That has really started to inflect in 2023, 2024, particularly with the observation that AI is more compute intensive than other categories. So there's a lot of growth in energy demand that is going to come from data centers. The reality, though, is that there's growth coming from everywhere. So all of these themes, the electrification of everything, the growth of American industry and reshoring of manufacturing, data centers, all of that is contributing to energy demand that is increasing for the first time in 2 decades. And that's a really material impact to the market, where we are going from a reality where demand was pretty stable since the financial crisis to a world where demand is increasing. And with demand increasing, there's a real need for new infrastructure as quickly as we can build it. And about 95% of the current interconnection queue is associated with clean energy of various kinds. And so that, I think, highlights the reality that transferable credits are already bringing to market more energy and power to meet the needs now that are coming from data centers and other categories of energy demand. And that's a really critical theme that we continue to make a reality, need to make a reality as we continue to meet the needs that are growing in the market.
That's a good segue. Stephanie, before we kind of start to wrap up here, I want to ask you about some of the considerations when it comes to newer credit types. What are the considerations that these new credit types are posing? Maybe we could touch particularly on nuclear. And then also, if Timmy, I know you touched on 45X, if we want to touch on those two, that would be great.
Yeah, sure. So nuclear PTCs became popular in the later half of 2024. I think we had about 12% of the market was supplied by nuclear PTCs. There is still guidance forthcoming on the exact calculation of those nuclear PTCs. However, the sellers that are able to transact, I think, are just taking a conservative approach and assuming the most negative outcome under the guidance and then selling the nuclear PTCs that they feel confident would still be available. Because it is a production tax credit, it has, a pretty straightforward risk profile. And we do find that a lot of buyers, including first-time buyers, have an interest in those credits. They are also generally large in size, so you can buy a large amount of those and offset almost all of your tax liability. And then lastly, a lot of those sellers have a very strong balance sheet or credit worthiness. So just an all-around attractive credit. Happy to talk about 45X unless Timmy, you'd like to kind of jump in on what you see.
Yeah, no, happy to. So we're really excited about all the opportunity we're seeing in the 45X advanced manufacturing space. and for a number of reasons. And Alfred touched on some of this, but I mean, it really checks a lot of boxes in terms of promoting domestic manufacturing efforts, shoring up our supply chain domestically, creating more jobs. And it also gives us an opportunity to offer more diverse set of tax credit transfer opportunities to our buyers. So we closed our first 45X transaction last year. And proud to say, the result of that was, new facilities were opened with our manufacturer client. We were able to bring more jobs to the U.S. So I think there's just a lot of, momentum behind this credit and support for this in the industry. And, we're actively working on ramping up that volume here in 2025. Some of the challenges I think that we've observed with this market is just the optionality I think that the manufacturers have. There is the ability for them to go the direct pay route as opposed to transferability. So they have sort of choices in terms of, what makes the most sense from them from an economic perspective. And so I will say with this tax credit type, the amount of price per credit and the timing of payment is really important to these manufacturers. The sooner they can get their transfer proceeds and the higher the price, the more it makes sense for them to take, sort of pennies on the dollar as opposed to waiting to collect a check from the IRS if they were to go the elective pay route. So I think how that's translating into deal volume and flow is just, this is a quicker moving train in terms of these tax credit types. Our manufacturers that we're talking with want to get to closing quickly. So it might be a little more challenging for maybe a first-time buyer who's still kind of wrapping their arms around, the transfer market and the pace that this credit moves. So I would highlight all of that. But again, we're really excited about all the growth in this space. And I think that the Crux data is reflective of that.
Yeah. And the only other thing I would add there is, you are right, Timmy, is that I think the 45X does move quickly. And one thing we've found that buyers like is actually the diligence process for 45X. It tends to be lighter. And I think, now that a lot of the sellers have transacted in 2024, they've fleshed out their due diligence process and their deliverables, generally what a buyer would be expecting to receive, whether that's a legal memo or a report from a Big Four. And so I actually expect that in 2025, we may see these transactions move even more quickly just because of that.
And there's a lot of, go ahead, Tammy.
No, I was just going to echo that. I was going to say, we've been observing that too. So the more well-packaged that diligence package can be when the manufacturer brings you these opportunities, the quicker you can kind of get off to the races with these transactions. So completely agree, Steph.
There's also so much 45X coming. So there were something like 170 investments that have been announced in manufacturing and mining facilities of various kinds across 37 states, totaling billions of dollars, hundreds of billions of dollars. And so that means a lot of those credits that are associated with manufacturing batteries or mining and refining critical minerals are coming to market in 25, 26, 27.
Yeah. And creating those opportunities for efficiencies, right? That you touched on, Steph, of like, okay, you get one done this year, and then how can we programmatically approach the market with this going forward?
Yeah,
totally.
And Maeve, I know we're getting close on time and I want to be mindful, but Timmy brings up something that I'd love to talk about, is just what can sellers and buyers do maybe to be kind of successful in the market. And, I think, Timmy, you hit on something there, right? Being buttoned up and having your memo and being ready to go. I think there's certain things that both buyers and sellers can do to really be successful in the market. And that's definitely something that stands out to me as we see some standardization around diligence. I think on the sell side, if you understand what buyers have as expectations and you have that ready to go, if you have sophisticated legal counsel that's representing you, that, you understand generally market terms. I think also for sellers to know what maybe their hot button issues are, or maybe their deal breakers, and really bring those to light up front as they're meeting kind of multiple buyers and investors, just to kind of figure out if they're the right counterparty, is also really important to me. Alfred, I don't know if you guys have anything else that you would say for the sell side as to being ready to transact and being successful.
No, I agree with all that, Steph. And I will say we have seen an evolution, at least with the hybrid structure, right? Like in 2023, I think developers, it was still sort of like, well, if you want to transfer your credits, that's maybe we're maybe seeing that more as, well, that's, for the investment member to sort through. I think there's now a realization in the market of like, wow, this is how we're going to drive more investment into tax equity structures. And so we are seeing sort of, to your point, Steph, the shift in developers and realizing like, okay, we all need to work together here. There's things that we need the sponsor to do, right, in terms of registering the project and actually filing their tax return with the transfer election statement and things like that. So definitely, as we, just get folks up to speed, the more we can all realize like we're all trying to, row in the same direction here. I think that's just going to help drive more growth and efficiencies to the market.
Totally agree with that, Timmy. And the other benefit of people having alignment on what deals look like, what's required, what documentation looks like, is that the deals can move a lot more quickly. We're building a lot of that stuff into Crux. So people that are using the platform are able to access our checklists for buyers and sellers to understand what level of documentation is required to support the transaction. We have standard documents that are used by more than 50% of transactions on the platform available to everybody that's a user. And we're launching features to make it easier to have commercial negotiation on those points. So features like a term sheet builder to help people get to alignment on the commercial terms that feed into the standard documents. Because as we have more alignment, Timmy, we can drive more convergence. With more convergence, we can build it into the software. With it built into the software, deals move faster and better.
Yeah. And I think one other interesting note I would just say is I think because the market is moving so quickly, I remember a conversation I had with a well-known sophisticated attorney last year. And, he said to me, I'm not closing transfer credit deals the same way that I was closing those credits 6 months ago. And I think that standardization, Alfred, that you're talking about is really helping kind of focus people on what is necessary to maybe get these deals done and get them done efficiently and effectively.
Perfect. We've got just a couple of minutes to go. So my very last question for all of you, and this one really is a quick hit question. What are each of you going to be watching for in 2025? And Stephanie, we can start with you, and then we'll go over to Timmy and Alfred in our last 2 minutes.
Yeah. So I think what I'm going to be watching for is really what the sophisticated groups, specifically sophisticated buyers, are doing. I think where other buyers maybe have some uncertainty around their tax liability or what credits they want to purchase, I'm very interested to, watch and see what the sophisticated buyers are doing in the market, how they are entering the market, what credits they're purchasing, because I think it will be telling, and I think other buyers will end up following them. So I expect that we are going to start seeing those groups transacting soon to kind of get an advantage on pricing and the deals that they're seeing.
Yeah, so I can chime in. So what I'll be watching for in 2025, I think we've covered a lot of ground to date in terms of the standardization of documents and diligence, but I still think there's a ways to go and probably more so for some of these, newer tax credit types. So I would just say more standardization to drive more efficiencies into the market. And, also kind of watching for maybe more creative structures to evolve as we look to drive more and more volume into the space. I'm also excited to see what happens with 45X.
I'm super excited to see the market continue to grow and develop. But one thing we haven't talked about here that I'm excited to watch is the extent to which the transferable credits and developments in that market change the way that the rest of the project capital forms. We are already seeing some pretty considerable impacts as the volume of the forward commitment market increases. We're seeing the volume of the bridge lending market against forward commitments improve and increase. And I think that as we start to get more maturity in all of those different kinds of capital categories, there will be even more opportunities for us to build more efficient capital stacks for these projects that we really need to build, given where we are in the energy picture of the country.
Absolutely. Lots more to discuss watch this space, make sure you download the Crux report. Thanks so much. I know the Crux team has been answering a lot of questions in the chat, and we got to several of them. If we didn't get to your question, don't worry. We do have a record of all of them. We'll be addressing many of them in our coverage, and you can always follow up with the Crux team around them. The recording of this event will be available later, and you'll get that via email. Make sure to keep an eye out for upcoming events, either on our site or on our website. And just want to thank each of our panelists so much for their insights. And thank you to everyone for tuning in. Have a good rest of your day.
Thanks, Maeve.
Thank
Bye,
you.
everybody.
Thanks,
Good to
guys.
see y'all.